Have you ever wondered how the stock market works? It's a bustling hub where companies and investors come together, exchanging pieces of businesses known as shares. Now, let's break this down a bit. Imagine you're a business owner and you need to raise funds to expand your operations. Instead of taking out a loan, you might decide to sell a portion of your business to the public. These portions are what we call shares. On the other side of the coin, we have the investors. These are individuals or institutions buying those shares, effectively becoming part owners of the business. They do this with the hope that the business will flourish, increasing the value of their shares, thus providing them with a return on their investment. In a nutshell, the stock market is a grand stage where these transactions take place. So, the stock market is essentially a marketplace for buying and selling parts of businesses. You might be asking yourself, why should I invest in the stock market? Well, the answer lies in the potential for financial growth. Investing in the stock market can offer a return on your initial investment. This is essentially a reward for putting your money to work in the economy. Now let's delve a bit deeper into the magic of compounding interest. Picture this. You invest a certain amount of money and it grows. Then the growth from the first period is added to your initial investment, and that total amount is put to work in the next period. This cycle repeats and the growth keeps on multiplying. That, my friends, is the power of compounding interest. So, why invest in the stock market? It's more than just buying low and selling high. It's about harnessing the power of the economy and the magic of compounding to grow your wealth. Investing in the stock market is a way to grow your wealth over time. It's crucial to understand that investing involves risk. Now, what does this mean? Each time you invest, there's a chance that you might not get back your initial investment. In fact, you could even lose all of it. But don't let this scare you away just yet. The potential for loss is balanced by the possibility of a significant gain. This is the risk and reward relationship. Think of it like a seesaw. On one side you have risk and on the other reward. As the risk increases, so does the potential reward. However, it's important to note that a higher potential reward doesn't guarantee a higher return. It merely indicates a higher possibility of a significant return, along with a higher risk of loss. So how can we manage this risk? One effective approach is through diversification. Imagine not putting all your eggs in one basket, but spreading them across multiple baskets. In investment terms, this means spreading your investments across various sectors, industries, and even countries. By doing so, you're not reliant on the performance of a single investment, which can help to reduce risk. But remember, even with diversification, there's no guarantee against loss. The stock market can be unpredictable, and even the most diversified portfolio can suffer losses. That's why it's essential to understand your own risk tolerance and invest accordingly. Being aware of the risks and managing them effectively is a key part of successful investing. So you're ready to start investing. What's next? Embarking on your investing journey might seem daunting at first, but let's break it down into manageable steps. The first step is setting up an investment account. There are numerous online brokers available, each with their own unique offerings. Some have lower fees or offer educational resources for beginners. Take your time to research and choose one that fits your needs. Once you have your account set up, the next task is to start researching companies. You might be tempted to invest in a company because you've heard its name in the news or because it's trending on social media. However, it's essential to make decisions based on solid research rather than buzz. Look at the company's financials, consider its prospects for growth, and think about whether its business model is sustainable. There are plenty of resources online to aid your research. After you've done your homework and found a company you believe in, it's time to buy your first shares. This is an exciting step, but remember, investing isn't about making a quick buck, it's about growing your wealth over time. So don't be disheartened if you don't see immediate returns. In fact, you should be prepared for the possibility of your investments decreasing in value in the short term. This brings us to another essential point, the importance of investing for the long term and not trying to time the market. It's nearly impossible to predict the perfect moment to buy or sell. Instead, adopt a strategy of regular investing. This could mean setting aside a certain amount each month to invest, regardless of what the market is doing. This strategy, known as dollar cost averaging, can help you navigate the ups and downs of the market. Finally, keep learning. The world of investing is vast and constantly changing. The more you know, the better decisions you can make. Remember, the goal of investing is to gradually build wealth over an extended period of time. So be patient, stay informed, and let your money work for you. As a beginner investor, there are some common mistakes you'll want to avoid. One of the most prevalent mistakes is investing in a company without fully understanding it. Imagine walking into a dark room without knowing what's inside. Sounds risky, right? The same applies to investing. It's essential to do your homework, understand the company's business model, its position in the industry, and its financial health. Investing in a firm without understanding these factors is like betting on a horse race without knowing anything about the horses. So remember, knowledge is power, especially when it comes to investing. Another common misstep is trying to time the market. Some investors believe they can predict when stock prices will rise or fall and make their moves accordingly. However, this strategy is akin to predicting the weather without a forecast. The truth is, even seasoned investors struggle with market timing. Instead of trying to outsmart the market, it's more prudent to adopt a long-term investment strategy. Stick to your plan and remember, it's about time in the market, not timing the market. The third blunder to steer clear of is letting emotions drive investment decisions. It's natural to feel euphoric when your stocks are soaring and anxious when they're plummeting, but making impulsive decisions based on these feelings can lead to regrettable mistakes. Be mindful of these emotions, but don't let them dictate your actions. Decisions should be based on sound financial analysis, not on the roller coaster of emotions. Finally, some investors fail to diversify their portfolio. Putting all your eggs in one basket is a risky strategy. Diversification, or spreading your investments across a variety of assets, can help mitigate risk and smooth out potential losses. By avoiding these common pitfalls, you'll be well on your way to becoming a savvy investor. The road to successful investing may be fraught with challenges, but by being mindful of these mistakes and learning from them, you can navigate the investing landscape with greater confidence and poise. Let's quickly recap what we've learned today. We embarked on a journey, a venture into the world of the stock market, a realm teeming with opportunities and challenges alike. It's a marketplace, a bustling bazaar where shares of public companies are bought, sold, and traded, acting as the lifeblood of our global economy. We learned that investing in the stock market is not merely about making quick money, it's about financial growth, securing our future, and contributing to the economy. When we invest, we become a part of a company's journey, sharing in their triumphs and setbacks. We learned that every investment carries a degree of risk, but with that risk comes the potential for reward. This is the fundamental principle of the stock market, the dance between risk and reward. We delved into the concept of risk and reward, understanding that they are two sides of the same coin. The potential for higher returns often comes with a higher degree of risk. However, through diversification, we can spread this risk across multiple investments, cushioning the potential impact of a single underperforming asset. We then explored how to start investing. It's not as daunting as it may initially appear. We start by setting clear, achievable financial goals, followed by extensive research on potential investments. We learned about the importance of building a diversified portfolio, spreading our investments across different asset classes to mitigate risk. We also discovered the significance of regularly reviewing and adjusting our portfolio in response to changes in the market or our financial circumstances. Next, we highlighted some common investing mistakes to avoid. We learned that following the herd or making impulsive decisions based on emotions can lead to costly mistakes. Instead, we should make informed decisions based on thorough research and analysis. We also understood the importance of investing for the long term, not getting swayed by short-term market fluctuations. And here we are at the end of our journey, equipped with a basic understanding of the stock market and a roadmap to start our investing journey. But remember, this is just the beginning. The world of investing is vast and constantly evolving. It requires patience, discipline, and continuous learning. Remember, investing is a marathon, not a sprint. Patience and discipline will be your greatest allies on this journey.